Okay, so we continued our winning streak, but I don't think that this winning streak will last very much longer on a day-to-day basis. And you could see that by the end of the day, and as well as other signs that I'll break down. There's actually a lot of technical signs of weakness, not bear market weakness, but this short-term weakness, and I'll highlight those in today's video. And see how that impacts our expectations going into this week and then beyond of when this train is going to leave the station. This bull market intermediate run train will leave. So we'll talk about that, and we'll also take a look at a sector that had been, very weak sector, showing some signs of life. But today, a little bit more of a breakdown, especially in the stock that we're looking for a trade idea. So let's go ahead and get started. Today is Monday, June the 10th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, let's start off with the S&P 500 using the market forecast indicator here at the bottom. You can see the intermediate lines crossed up above 50, so a nice little rally, 5-day winning streak here. Let me get rid of these lines for a second. A 5-day winning streak getting us back up above that moving average, which would be the 6-week moving average. Still declining though, so that's why it's yellow, and it will be yellow tomorrow too, because we are above a falling moving average. And the good bullish combination is dark green shading with a green line. And so we won't get that tomorrow yet. So we're not, again, the train hasn't left the station yet, just like we mentioned on Friday. In fact, we're expecting this near-term line to pull back down. It came down a little bit more. We kind of needed to get down below 50, similar again to what we saw over here on the left when the near-term line came down after the initial bounce, pulled back below 50, and then we rallied for your regular near-term runs. That's more of what I'm expecting right now. Over here, though, we were below the moving average, was red. Here we're up above it, so that near-term pullback might allow the time for the moving average to turn around. Might even bring the intermediate line, as we've seen a lot before, bring the intermediate line and dip it below 50 a little bit, maybe get some light pink shading or even dark green pink shading, and then turn it back up, and then away we go. So we'll see if that ends up being the case. That's the expectation. The Dow looks almost exactly the same. Very small range today, but crossing up above 50. The Nasdaq's been a little bit weaker, and the Russell too. And you can see the long upper shadow today on the Nasdaq. So another sign of weakness in the near term that we're seeing here. And again, kind of supports the idea that we talked about on Friday, that I'll reiterate here, that we might get a little bit of some near-term weakness here early this week before bouncing later in the week, if not early next week. So we'll see if that ends up being the case after the gap this morning, but then spending the rest of the day coming down, closing near the lows. So we'll see when we get to the intraday chart. The Russell 2000s had a good day today. You see over here on the left, emerging markets, Russell 2000, commodities all did very well today. Interestingly enough, value stocks really outpaced growth stocks, which were down on the day. But you can also see, and with commodities doing well, crude oil was down. But you can see these other safe haven areas, gold and long-term bonds all down today. The dollar bouncing up a little bit. But small caps, which has been really underperforming. In fact, if you take a look at the underperformance chart here, the underperformance of small caps relative to large caps is very similar to what we saw in early 2016. Early 2016, if you recall, was another death cross environment. We kind of had a back-to-back death cross environment here. And then look at the rally that we had in small caps going forward. And we also had the same rally in international stocks and the fall in the dollar. So very, very similar environment we're seeing now compared to what we saw in 2016. So very good sign actually for risk appetite as a whole, especially in the small cap space, but also for small caps, right, and international stocks and sectors that are kind of related to any kind of weakness we might see in the U.S. dollar. So that's kind of what we're seeing here across these major indexes. Go back to, the market forecast here for the Russell 2000. So, again, its intermediate line's not up above 50 yet. We haven't crossed above the moving average yet. So you can kind of see, we're not getting that Dow theory type of confirmation across multiple indexes that says away we go. another sign of weakness, another sign not of general weakness, not that this intermediate trend is going to roll back over, but sign of a near-term weakness that will get some hesitation, some volatility first before that bullish train leaves the station. We start on a new intermediate run, of the typical 1 to 3 month time frame. All right, so before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video. Also, while you're down there, click the thumbs up icon. That tells me, number one, you got something out of the video today. Makes sense. And number two, it says you want us to do the video again tomorrow. So if that's the case, just one click. You can do it right now while you're watching and let us know down there. Also, comment down below on anything that stands out to you from today's video. Join our daily Market Outlook email list that we have. There's a link popping right there in the top right corner of your screen. Click that link to subscribe. Very easy way to do that. Follow me on Twitter for more content like this in between the videos. And then join our Market Outlook community that we've created on Facebook. Also, we invite you to subscribe to our website. If you're watching our video on our blog, just right above to the top right corner of your screen underneath this Join Market Scholars, hit this icon. That will take you to the page where you can subscribe for free, and that gives you the ability to participate in our Market Outlook forums with other market scholars that watch these videos, be able to communicate and go back and forth with people, including Brandon and myself. Also, remember too, we have for the premium subscribers, we have our class schedule over here to the right of classes that are coming up. Our normal Tuesday schedule here, and then of course we make it really easy for you to engage with us on Twitter and Facebook by putting tonight's Market Outlook tweet and Facebook post right here. You can just click on those from here. Again, the more you engage with us on those social platforms, the more that they will push you all the content that we put out there on those. So we try to make that as easy as possible for you. All right, with this last week's move and close above the 50-day moving average, we're holding it so far, so that's a good sign. You can see the 50 and 200-day moving average are both rising. We're above both lines, so bullish from that perspective. And even though you can see this week's range is very small, you can see we're back to having bullish Hakinashi candlesticks. So that's another good sign. We were looking for this transition candle. We got it last week, and that transition usually leads to a bullish move to the upside. And that's where we're headed now, here. So that's and again, for us to not get a bullish candle next week, we'd have to really fall down here, probably about below 28.55, 28.50 area. So a good sign from that perspective, from a long-term perspective. If you take a look at the 3 green arrow chart, of course, you got 3 green arrows again. We don't have the green line yet, right? The moving average isn't rising, even though we're trading up above it. If you look at the 2 line versions of those charts, the 8-day now has crossed the 17. So there you go. There's the MACD crossing above 0. It's another stage in the trend reversal. Now you kind of need both those lines to cross up above 30. And again, don't be surprised if we don't pull back down towards the moving average. Now that we've crossed above it, pull back down below it, and then make our run. You can see that here, pull back down, then make our run. So that's what I'm expecting here, that we'll pull back down, maybe touch the 8-day moving average again. And that actually is below 28.50, so we'll see how big, how extended any near-term pullback will be. Keep in mind, if I look at the retracement levels here, going up to today's high point, there you can see 28.37 would be, or 28.36 would be a 38% retracement. That'd be perfectly normal. So in any kind of near-term drop, that's an area to be targeting. You can see it would be right around where, depending upon how quickly we get there, right around where the 8 and the 17-day moving average would be, especially by then. Shouldn't be too surprising to see that we have a new 4-week high point today again. So up to 290 is our new 4-week high. 290 is an important level. That's the level, remember I told you, we break above that and we're on our way. It doesn't look like we're going to be able to hold a breakout above that. So again, another sign of weakness in the short term. But again, we can pop all the way down here to 281 or 282. That's where the Hakinashi Open is for this week. That's where the 4-week range is for this week. So we've got a lot of room to pull back and still be very bullish on the short-term chart. So very good sign there. And of course, you look at the Bollinger Bands for SPY, you can see the same thing. I mean, there's some resistance here in this area. We're not able to get up and through this yet. And really, 290, it's really going to be like about 293. That's when like, the train will be leaving the station at 290. That's where the volume node is right there. But by getting above, it will start really chugging, and once you get above 293, it's going to be at full speed, breaking out above the value area and taking off to the upside. So we're obviously not there, but we are pushing up against the upper band. We're getting more. You can see how we can stay in the upper half once you get above it. Now we can get above it temporarily. We were in a downtrend there. We're not quite in the same level of downtrend here as we were back on those bounces. So we'll see if this bounce into the upper half of the Bollinger Band width looks like this, or ends up looking like the trend, like what we expect it would be. And then finally, let's take a look at the DMI for the S&P 500, and let's actually look at SPX since it's not as dependent upon volume. And you can see again another sign of weakness. Another sign that we're not quite out of the woods here is we are above 25 on the positive, and that's a good sign. But you can see we need to get below 20 on the downside to really get this bullish trend established, and the orange line's not there yet. That's when we're really bullish, and we've had some bearishness here, and we had some this peak that we're coming down from that almost got up to above 40, the blue line getting down below 15, and now we're reversing. But again, don't be surprised if we get a little bit of a hiccup here first. Finally, I forgot to look at the range for today. Remember, you have to include the gap, so keep that in mind. But if you look at the gap here, you can see we closed at 287.65. The low today 288.87, so a little bit more than a point, probably a point and a quarter. You add that in here, so you're about you're at 2 right now. You add another point, so you're about 3.25 points, a little bit below average on the range, a little bit below average on the volume. Again, that's good, actually. That's a good sign, excuse me, this chart here. That will bring these lines down, and that's what you want when you're bullish. And then finally, the volatility did not come down today. So again, another sign of weakness here. Again, we had to drop below 90. That's when that train has left the station, and this has got to drop below 15. And you notice we're not there. So don't be surprised if we don't make a little bit of a pop towards 1 in this near-term pullback before we turn back around. All right, so before we break down now what's moving price today, kind of what's behind the scenes, and our trade example of the day, summarizing our technical outlook, that as we said on Friday, we had a good run last week, very overextended in the short term, more than likely, especially with the news overnight on Friday night, that was probably being priced in for at least Thursday and Friday of last week, at least Friday. We'll probably now get that buy the rumor, sell the news type of knee-jerk reaction. We gapped up, we rallied early to a new high, and then came down and closed near the open, right near the low of the day at the open. So producing the long upper shadows, a little bit of a bearish move, and don't be surprised if we don't fill in this morning's gap early, either tomorrow or Wednesday. So, and then, like I said, after that, bouncing back up, getting the intermediate trend going across all the major indexes, and then away we go from there to the upside. Not like we're going to rocket ship to the moon like Beyond Meat is, but more like our normal intermediate run. We'll be starting another normal intermediate run of 1 to 3 months. Hopefully it would be normal, because as we've seen in the past, the abnormal intermediate runs that last longer than expected lead to pullbacks that are a lot more uncomfortable, as we recently saw. A 4-month intermediate run gave us a pullback that a lot of people just, it was bringing up bear market calls and recession calls, and people were going a little nuts, and we hadn't even dropped 38% retracement. So we would like to see just a normal intermediate run on the next rally. So what do you think? Do you agree with that assessment, that technical assessment, or disagree? There's a link popping out right there. It opens up a poll, and then vote. Either hit agree or disagree. If you vote disagree, remember at the bottom, let us know what you're seeing that would suggest either a more bearish posture than what we're expecting, more weakness than just a short-term pullback, or maybe you're not expecting that pullback at all, and the train has already left the station for you. For whatever you're seeing that would suggest that, please share that down below in the comment section. All right, now let's take a look at what's moving the price action today. And you can see the biggest winner today was emerging market stocks. Remember, emerging market stocks got held back last week by crude oil despite the weakness in the dollar. Well, interestingly enough, the dollar rallied today. Crude oil dropped today, was down 1%. And emerging markets had the best performance of the day. So it's interesting how that's played out. And then small cap stocks also at least started the day with a good move. I mean, everything kind of pulled back by the end of the day, but small caps and emerging markets really did well. And that's your risk on asset classes. Commodities also did really well, especially you can see agricultural commodities. Again, a reflection of the trade, and that's a lot of chatter about the trade issues with China, and you can look at those agricultural commodities as a reflection of that. On the other end of the spectrum, you can see, again, from a risk-off standpoint, the long-term bonds and gold down there. Now, remember, long-term bonds, has really had a weak move. So, I mean, look at TLT. You can see it's rather overextended, very, very overextended. If you look at the long-term view here, pull up TLT, which is not the 10-year note. This is the 20-year plus ETF. But you can see the rally it's had. It's a major component of our class portfolio and portfolio management in our class that we do. So it's been doing really well for that class in that segment of our portfolio. But it's starting to pull back here, and that's not surprising, right? The 10-year note had dropped down to almost 2%. We talked about the idea that it's probably going to now bounce up to about 2.4%, despite the odds of a rate cut that are increasing, and that's put pressure on the dollar, the pressure that we've been expecting for a while on the dollar that we now might finally be getting here. Remember, it's got a dark pink shading and a dark red line despite today's Harami pattern. We'll see if that Harami plays out into anything more than just maybe a 1 or 2 day bounce. But the idea of the dollar breaking below this trendline support and breaking below recent lows, especially a double top low, suggests that there might be some more weakness ahead, especially considering the rate cut odds, which are at very, very low here. You look by September, and the rate cut odds are 93% for a rate cut by September. Most likely by July, they're above 80% for July. So it's looking more and more like we might get one, not here at the next meeting, but the one after. But most likely by September, and then another one by the end of the year. You can see you have about an 83%, 84% odds of a second rate hike when you add these two together and subtract it from 100. So, and then that might be it. I mean, you go forward from April and you can see, okay, we have really high odds of one cut by next April. One cut by next April, about 98%. Look, there's small odds of a rate hike, but again, grain of salt there, very, very small. Then you add that, you got 13%, which means you got about 87% chance of two. And then you add this, so you got 13 plus the 25, and you're looking at about 40%, which gives you a 60% chance of a third rate hike by next April. That's a few more meetings. So in other words, still a high probability, but the most likely scenario as of right now that's playing out is that we'll get 2 rate cuts by the end of the year and then be done. There still might lean towards rate cuts, but we're not getting that high priced probability there. Now, of course, the employment report was the big news last week. We didn't have very much today. We had the JOLTS coming out today, job openings. If we were to take a look again, it's a green indicator here on Ocano Day's economic calendar, so not as important. But you can see we're not rising up very much. In fact, coming down a smidgen from the prior number, even when it was revised. But still at very high levels, so it's not like we're dropping down to nothing. We got very important data coming up here later in the week with the PPI and the CPI data, import and export prices, and then retail sales and industrial production by the end of the week. So This is going to be a busy week from an economic standpoint. Right now, the macro picture is not looking good for the dollar. But that's not a bad thing, right? Obviously, it's a rate cut environment that's been bullish for stocks. So, we're looking for that first rate cut. And we're in an environment where small cap stocks are so oversold relative to large cap stocks that in the past, combine that with the decline in the dollar, has led to a really good move in stocks and small cap stocks and international stocks and other sectors that we'll see here in a second. You can see the GDP estimate is at 1.4% for this next quarter. It'll be updated here on Friday after all that data comes out, but still relatively low, again, relative to the last couple of quarters, which have had really strong numbers. Let's take a quick look at what's going on with the foreign markets, and there's a little bit of an issue there, but you can see some of these foreign markets, Mexico especially rallying. Obviously, we know why. Indonesia rallying, Turkey rallying, up South Korea. So again, kind of your smaller areas in the emerging market space. Brazil lagging behind a little bit. India also lagging behind. Small gains in Russia. A decent move in China, but not a move to break out yet. But you can see some of these developed areas are breaking out. France is breaking out. UK is getting above its moving average. Germany is making a run up there. Italy is getting up there too. Canada is back up above its moving average. So all looking very similar to the U.S. stock market. Remember, they've been lagging behind for so long because of the strong dollar. There's going to be some opportunity here for a lot of these areas. Now, we don't see very many green lines. You'll see one on France. France will actually have a bullish pattern here with a dark green shading crossing above 50 on the intermediate line and a rising moving average. So that combination, if you see here the moving average, you won't be able to see the line, but pretty soon it will be rising, and that will give you your that bullish pattern. Nothing is green currently except for Russia, and Russia's got the bullish combination, and so does Brazil. So strong bullish trends there. Everything else is improving. China's not quite improved enough to get the intermediate line up above 20, much less above 50. In fact, the only other ones above 50 are France and Canada, and the U.S., and everything else is still lagging. Germany's a little bit behind. Japan, Italy a little bit behind. The UK a little bit behind, and then of course Korea kind of matching. It's kind of the proxy. These two kind of go hand in hand, Korea and China, especially on the trade issues. There's a lot of green on these charts. Of course, your top two sectors that have been performing lately have been your interest rate sensitive areas. In fact, they're some of the only ones that have the green lines and the dark green shading. Staples as well, healthcare as well. Materials, you can see the turnaround it's getting, finally getting that strong pattern that we expect to also see from other dollar sensitive areas like energy and industrials. They're kind of lagging, energy lagging the most. So from a valuation standpoint, there's opportunity in energy, as we saw on Friday. It's the worst performer of the last 200 days. As usual, when you see that kind of pattern, you expect it to flip, and in fact, you can see again this pattern, which is a very, very bullish pattern when you have that kind of returns in these safe haven areas over the last 200 days. But if I were to go back to the 200-day period that ended August 22nd to see what it looked like, let's see, it was in 2018, so right, to see what it looked like heading into to where we're at right now, and you can see, whoops, sorry, it needs to be over here, August 22nd. So here is what we look like going into it. So into that 200-day period, into this past 200-day period, we had this kind of return that started us off. So these safe haven areas did really poorly, and these cyclical areas are doing really well. And of course, it flip-flops. So we expect the energy sector, which has been your biggest loser, to flip-flop even more and get up here to the upside. And because it's been, as you saw, energy has been a laggard for a while, but heading into like July and you can see May, it was a strong performer. It flipped to the downside before these other cyclical areas did, and really got hurt more than anything. And again, we expect it to flip back to the upside. In some of these areas, to some extent, you can see healthcare is kind of looped in here, and some of those would be kind of dragged down too by, in fact, if you were to go to the sector comparison chart here, let's go here, and then let's go back on a custom time frame to August the 22nd of last year, heading into now. So there's your 200-day period here. You can see, your safe haven areas and how they perform. They held up really well during the pullback. They've had double-digit gains when the market's been flat. Healthcare, which is kind of this brown line, had been an outperformer along with them. Then really kind of deviated here in April. It had its big declines. It had bounced back up and has been trying to recover here lately, but has been really kind of lagging behind since these outperformance gains that we had in February. And so there's opportunity to continue to take advantage of that underperformance. We've been looking at some trades in the healthcare area, specifically in the kind of insurance area, and that's more of a safe haven area for bullish trades lately. But the drug industries haven't looked so good, at least especially today. In one of the stocks, Eli Lilly, if you take a look at, let's actually take a look at its chart here. We'll do the market forecast first. Give that 1 second low. There we go. You can see it has the dark pink shading, and it will have a falling red line. So that will be a bearish combination because you see moving averages down. So tomorrow it will turn red. That's a bearish combination over extreme low and momentum line, breaking through a lot of lows here with today's move, almost 4% drop to the downside. There's opportunity here for more of a decline in Eli Lilly. You take a look at its long-term chart. We had traded up here. And it came down to the 200-day moving average, and it's filled in that gap and kind of trading at the bottom end of this long candle when we had all that weakness in April. Well, now if it falls through that low and the 200-day moving average, there's opportunity for weakness. Needless to say, if you look at the Bollinger Bands for Eli Lilly as well, we're really, really close to dropping below its value area, which would be another very, very bearish sign for a stock like this. Looking at its DMI as well, Eli Lilly, you can see cross above 25 on the orange line, cross below 20 on the blue line. That's a bearish combination from a directional movement index. Finally, looking at let's look at the 3 green arrows first on the regular chart. Lilly, you can see 3 red arrows, spike in volume. There's your bearish pattern. And then you look at the 2-line versions of those, and you can see the MACD had got to 0, stochastics had gotten above 50, now falling both below their moving averages. We had a convergence here, and it looks like there's a good chance we diverge to the downside. And so we can be aggressive here with this trade, considering you might get some near-term weakness in the markets that can weigh on this, but its own technical pattern looking very, very weak. So we can go out to August and say, okay, well, let's just buy at the money put. We'll look at the extrinsic value, the highest extrinsic value, and we can go for $5. Set a stop order at 50% of that. The stock bounces, then we'll take a loss. We'll position size smaller than normal because this is more of an aggressive trade. I'm not doing a bear call spread where we do a normal position size, higher probability. It's a low probability trade, but it gives me good reward potential if this stock were to actually continue down to the downside. So we have to manage our risk on that kind of a trade. So we would do a smaller than what you do normally. So if you normally risk, say, $1,000 on a trade, and not how much you put into the trade, but how much you would, the question that you're answering is how much would you be willing to lose on a trade? And if the answer to that question is $1,000, that's your normal answer. I'm willing to lose $1,000 on a trade in order to make money, right? You have to be able to be willing to lose money to make money. Then on this one, you probably say, you know what, I'd be willing to lose $500. It's a little bit more aggressive. I've got a better reward to risk ratio, more potential reward than normal for a high probability strategy like a short vertical spread. So I'll go for the $525. In fact, what I'll do here instead is I'll do a right click, buy custom with stop, and set our stop order at half of that 525. So what about would that be about 260? 530 would be, it's actually about 265, wasn't it? 525 divided by 2, yeah, about 2. Let's go 265. We'll put our stop order there. So now I'm willing to lose per contract $2.65, about half of that 525. That's how much I'm willing to lose per contract. Now I can position side and say, okay, well, if I'm going to lose $265 per contract, I'm willing to lose $500 roughly total. Then I can do 2 contracts. Put those together. I can do 2 contracts, and that's how you position size. And maybe your normal position size would be 4 in that case, but we'll do 2 here, knowing that it's got more potential reward. Low probability means more potential reward for the risk I'm taking. I'd be willing to take that $265. You know, I've got some flexibility here, so I'm willing to take that loss, put that GTC, and then we'll see what happens. And as it continues to go to the downside, knowing that if it probably gets back up here above 120. In fact, if I analyze that put, analyze that long put trade, and here, let's just do single symbol and do set slices of break even. So remember, I'm willing to lose $265. So today, that would be a move up to right in here, up above 120. So you look at that on this chart, we'd have to get back up above those highs, essentially. So nullify the breakdown and get back up above those highs. Eventually, you know, if we were to break up above today's high, it's a pretty good chance we're not going to, you know, it's not going to hold. So if we were looking at that, I mean, that's at, you know, 116 in that area. So if you look at, keep that in mind when you're looking at 116 right now, I would not have a 200. I'd only have about $100 loss. But remember, as time passes, this is a negative theta trade. So as time passes, you're looking at about, was it 265 we're willing to lose? So you'd be looking here, and let's go out to August on this. There we go. So, you know, you can see that we basically have time. We have until about a month from now to be able to stay below 116 and be within a loss that I'd be willing to take. And let that, you know, if we were to drop down, if this were to drop towards, you know, other Bollinger Band volume nodes for whatever reason. In fact, you can see if we were to make a 1, or this would be a 2 standard deviation run. If we were to make a 1 standard deviation run, then we have a $400 reward. And if, of course, to the downside, the moves are usually bigger. If it makes a 2 standard deviation runs toward $98, so in this area, well, even if it just gets down to 105 here relatively quickly, then you're going to have a pretty decent, here, let's go back and reset these parameters, down to 105, you'll have about a $500. You have about a 2-to-1 reward to risk ratio on this trade if we were to make that run here relatively quickly, which is the type of setup you look for from a reward to risk standpoint in a low probability trade like this, more of an aggressive speculative trade. All right, now you've heard from me. Now it's your turn. Let's keep this conversation going in our Market Outlook for our Market Scholars forums, in the Market Outlook forum on marketscholars.com. Remember, use that link right there. That will take you there. You have to subscribe first, but everybody can do that for free to participate in that particular forum. If you want to participate in our class forums, then of course you have to subscribe to our site. To do that. As always, thank you very much for watching tonight. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow me on Twitter for more content in between the videos, and join our communities on our marketscholars.com. We've also created one on Facebook too. You can join there. Have a great rest of your evening, everybody. We'll see you all tomorrow.